So, ladies and gentlemen, what a day it has been. Lots of information, lots of interesting companies for you to listen at. I hope you got a lot of value. This is going to be an eye-opener for some. Some of you will know our final keynote speaker of the day, and I know many of you have been saying that you can't wait to hear what his views are. His name is Mr. Rick Rule, and he is joining us today. Many of you, as I said, will know who he is, but for those of you who may not, let me just explain that Rick has been investing in the resources sector for most of his adult life. He is the president and CEO of Sprott US Holdings. He understands this market better than most. He is a commentator on the subject on various media outlets. I am delighted because this guy is busy, ladies and gentlemen, and he's giving us his time today to let us I guess to share with us his views, because right now the gold market is not on a tear as it has been in the past. But before we get started, Rick, welcome to the virtual gold conference via Zoom instead of in person.
Certainly a pleasure, Carrie. Thank you for inviting me. It reminds me of the first of your conferences that I worked in Sydney, where you appropriately made me walk through a clown's mouth at an amusement park before I gave my remarks. So there was something that my wife found very fitting about that entrance.
I'm sure Bonnie enjoyed watching you walk through the clown's mouth, but we're not doing that today. We're on the Zoom. And it's interesting, isn't it, Rick, how technology is allowing us to do things. And I do want to actually explore technology a little bit. But first of all, one of the things that you have said in the past is in your younger days, you often worried about making money. And it was all about, how do I make money? How do I make money? And then you said, when I stopped focusing on making money, and I started focusing on giving other people value, that is when the money started coming in. And I think that that's a really interesting look at, I guess, psychology, and the psychology, not just about making money, but investing. And I wonder if you could expand on that for our listeners today.
Happily, and I'm not saying it'll work for everyone. As a young man, a competitive young man, and by the way, a young man brought up by a single mother school teacher for whom finances were occasionally an issue, I was very wrapped up in making money, both to avoid insecurity, but also as a measure of self-worth. I've learned a couple of things since. One is that money is certainly not the whole measure of self-worth, nor even, frankly, the half measure. But that notwithstanding, at that point in time, it was consistent with my belief. And I did reasonably well at making money as a young man, too. Hardworking, intelligent as a young man can be, admittedly more testosterone than serotonin, perhaps. But anyway, but what I came to understand with my wife's help, you've met Bonnie.
Yes, I have.
Was that focusing on money is, in effect, self-destructive for a variety of reasons. The most important of which is that it forgets how money is made. Money is made irrespective of what you do by delivering utility. If you're a manufacturer, you build something better and cheaper than someone else. If you're a lawyer, you are a better litigator or a better investigator or something like that. And when I stopped focusing my economic activities on what my end would be and started focusing on delivering value, specifically concentrating my efforts on places like resources where I enjoyed them so much that I would have done them for free had they not paid so well.
Sorry to interrupt you, Rick. When you say you enjoyed them so much, what did you enjoy about resources? Because a lot of people go, why?
I like the natural resource business. I like the cyclical nature of it. I like the simplicity, frankly, of it, compared to, as an example, technology businesses, most of which I can neither spell or pronounce. I like what I see as the sort of three-dimensional chess game, where you are trying to understand future price trends, you are trying to do financial analysis, you are also absorbing as much information as you can about geology and engineering, and trying to arrive at different decisions more quickly than your competition. the sort of mental game associated with resource investing has always been pleasant for me. If you define work as some distasteful function that you have to do to make a living, I haven't worked very much in my life. I've put in a lot of effort, but I wouldn't describe much of it as work. At any rate, when I came to recognize that there were things that I enjoyed doing so much that it was difficult for other people to compete against me, and that the way that I could make money was by delivering value to other people rather than worrying about what my end of the pie was. Once I came to that realization, I literally started making what was, at least by my frame of reference, a lot of money, and very quickly. I mean, two things happened, really, maybe three things. The first is that my enjoyment in the process increased because my focus changed, which was nice. The second thing is that I've always styled myself as a capitalist, and making money was good because you can't be a capitalist without capital. And the third thing was that my reputation and my network expanded much more rapidly than before. The concurrence of those three things coming into that wonderful sharp bull market that we had in the early part of the decade of the 90s meant that after really 1990 or 1991, I never had to work for money again. I had enough money that I was taken care of for life. And so it changed the way I invested. That in turn, because we did well in the decade of the 90s when other people didn't do so well, set me up particularly for the bull market beginning in 1999 or 2000. I had the cash, I had the courage, and I had the reputation to go truly all in an epic bull market, which was very, very pleasant.
Which possibly others didn't see, but you said just then you did well when others didn't in the 90s. Could you just expand on that a little bit? Why you were doing well when others didn't? Was that the psychology of the investing you were doing, or did you just get lucky?
Three things happened, I think, in 1990, where I was shifting down market to exploration. Everybody else in resources was going up market to safety. And the consequence was we had an exploration boom in the early part of the 90s. The market was driven by small cap companies and by discoveries. And I happened, perhaps accidentally, to be at the right place at the right time. Several of my competitors were 3 years late to a 4-year bull market, which didn't help. I also was reasonably good in 1995 when that market began to look expensive. I'm not trying to say that I exited everything, but I exited 40 or 50% at the same time that most of my competitors, as a consequence of the bull market, were increasing their positions. So although both sides went over the waterfall, I went over the waterfall only half invested. They went over the waterfall fully invested. So losing half of a half is less of a sin than losing half of all. But then it began to be very clear to me in the sort of 1998 timeframe that we were going to go on just an epic romp, a truly epic romp. And I was able not merely to convince myself, although that took some doing, but more importantly, to convince my partners and convince my clients that it was time to get extremely aggressive. To quote Warren Buffett, one needs the courage to buy straw hats in winter and the wisdom to sell them in the summer. And we were going through in resources a nuclear winter in 98 and 99. Truly a spectacular period. And I guess the consequence of having been through so many cycles before that, but also frankly, having financial stability and a reputation, gave me both the courage and the tools to go all in a period where my partner, not my partners, pardon me, but most of my competitors were in the corner in fetal position or exploring things like technology or strong drug.
Rick, what gave you the courage at that point in time when everybody was as you say, sitting in a corner in a fetal position? What gave you the courage? And also, what do you think were the indicators that said to you, it's time to go all in when nobody else was doing what you were doing?
Great question. the thing that gave me the courage was having seen the same indicators before and knowing what the necessary result of that was. In cyclical businesses, you must be a contrarian, you're going to be a victim. So you have to relish loneliness. And being a resource person in 1998 and 1999 was the definition of lonely. But also, there has to be a reason for the loneliness. What I have learned, the great secret, if I have one, I'll divulge to your listeners now, which is that if you have commodities that are necessary for the ascent of mankind, things that are crucial to the way we live, if the industry is selling those items as an industry for less than it costs to produce them, in other words, if the industry is so unprofitable it's in liquidation, only two outcomes exist. Either the way we live changes for the worse because the stuff of mankind isn't available, or the prices go up.
Yeah.
It's really that simple. And through the decade of the 1990s, the prices for most industrial commodities were lower than the cost of production. So if you'll remember the famous cover of The Economist magazine talking about $10 oil and the end of oil.
Oh, yes, yeah.
I remember saying to clients, who drew this to my attention, I said, okay, I want to focus your mind on a question. Do you believe 5 years from now that when you leave your bedroom and go to the garage and turn the key to the right, that your car will start? You say, of course. So then you believe in higher oil prices, because if we don't have higher oil prices, there won't be any oil and your car won't start. It is that simple. Being a salesman, and I'm not a bad salesman, and being able to use a simple declarative statement to an audience that has learned over time to trust you even in bad times is extremely powerful.
Yeah.
So the realization that prices had to go up was important to me. And the realization too, that in times of maximum pessimism, there's maximum opportunities had been proven to me cycle after cycle after cycle. And I guess the conjunction of those two things, plus frankly, the fact that I was in a financial position where I could afford to take substantial risk with my own capital without changing my decision as to what to have for breakfast, probably mattered too.
You've said in the past, because it is a cyclical business. You were talking about the things about mankind and being crucial to mankind. Well, first of all, this is a virtual gold conference, so let's talk gold. We are in a very volatile market. In fact, it's a crazy market right now. We've got people with no idea who are going in and using the Robinhood application and saying, I'm just gonna put some money in and I'm going to speculate, gamble, whichever way you look at it, but they don't have an understanding. They are not reading balance sheets. They are not reading research reports. They're taking their advice from their mate down the road who also has no clue. The markets, excuse me, the markets are going up. Speculation is rife. The gold price is not doing very much. There are a lot of people on this conference today, some of whom understand the gold market a lot. Others are scratching their heads saying, well, it doesn't give me a return and I don't understand it. What would you say of this volatile market and the fact that the gold price actually has gone back in terms of its value in fiat currency terms?
Big question. So let's unpack it. The first is that while your audience and every audience looks for certainty, there's no such thing. So we have to talk in probabilities. If I absolutely positively knew it was going to happen, I wouldn't be talking. I'd be acting for sure, but I don't. And neither do they. So let's look at the probabilities with regards to gold. There is an argument that it's not essential for the ascent of humankind, the non-sexist phrase of mankind. I disagree with that. Gold has functioned for millennia as a medium of exchange, which is to say money, but as a store of value too. Most mediums of exchange, say Australian dollars or US dollars, aren't stores of value. They're promises to pay. They're in fact floating abstractions. But gold is lustrous, it's beautiful, it's malleable, it's divisible, it's consistent. It's wonderful money. It's something else too. Gold has functioned for at least 2,000 years as insurance against the collective, as insurance against your government, as insurance against the mob. And if ever there was something that is needed today in the political environment in my country and around the world, it's insurance against the mob, insurance against government. So I reject the fact that gold has no utility. I would suggest that it's just as important for the ascent of man as any other commodity, and perhaps more important. Now, let's get back to probabilities. Why do I believe it's probable that gold will go higher? Precisely the insurance function. Gold moves higher in many cultures for many reasons, but I would argue that the predominant reason is fear, and the predominant reason is fear in the ongoing purchasing power of savings held in more conventional instruments. With regards to gold, is that fear rational? I believe so for at least 5 reasons, as follows. Quantitative easing, which we talked about in our last interview. If you did it, if you printed carries, they would put you in prison. But if you were an MP, that would be policy, highly popular, and you would be reelected. Quantitative easing is by definition the manufacture by keystroke now rather than by printing of specious currency units. They're not increasing the currency because the economy is growing so fast they need more liquidity. Precisely the obvious. Precisely the opposite. And that debases the currency. The second is worse. Debt and deficits, deficit spending. Spending more than we have in order to stimulate the economy. When you do that, you steal growth from future periods. And when you get to those periods, you need to replace them. And of course, it's also an intergenerational transfer. Those Robin Hood kids that you talk about need to understand that debts are my generation spending their money on all kinds of cool stuff that we voted ourselves. So we get the benefits and they get the bill. Not a bad transaction from my point of view at 67, but not so good for the kids. The third and the most important from my point of view is negative interest rates. Interest is the compensation that savers get for foregoing consumption, a time preference. It also compensates savers for the time value of money and for the credit risk associated with the issuer. To me, the most important determinant of gold prices in my life has been real interest rates on the US 10-year Treasury, which is the world's benchmark security. However much non-Americans might not want to hear that, it is. And right now, the world's benchmark savings instrument pays about 70 basis points, 0.7%. In a currency that the Congressional Budget Office suggests is depreciating by 1.6%. In other words, the US government is being honest for a change. What they're telling you is if you give them money, they will give you back substantially less in 10 years than you gave them now. In other words, they absolutely positively guarantee a loss. My friend Jim Grant returns to return-free risk. And I don't see return-free risk as being a particularly generous offer, nor particularly stout competition for gold. The fourth reason is that gold is under-owned despite the first 3 factors. It is estimated, and I don't know the same Australian number, but it's estimated that precious metals and precious metals related assets constitutes less than 0.5% of savings and investment assets in the United States.
Yep.
And that's down from a 3-decade mean of between 1.5% or 2%, so it's under-owned. The fifth reason is that institutional investors worldwide manage about 100 trillion US dollars. And their traditional mantra has been 60% equities, 40% debt. The idea being that in slow economic times, when stocks go down, the interest rate declines and the capitalized value of that interest yield, which is to say their bonds, goes up. But that doesn't work at a negative yield. If 40% of your portfolio is showing you a guaranteed loss in purchasing power, and your job is to make sure that people who retire 30 years from now have a pension, you need to disintermediate out of bonds. Is gold going to get all of that? No, but traditionally gold has been a very good hedge against a long bond portfolio. So I see flow of funds coming out of debt portfolios into gold as a consequence of all of the preceding four reasons. Is this a certainty? No. Is it a strong possibility? Yes. Now, I realize this is a long-winded answer, but you gave me a big question. Gold's sudden malaise in the face of all these facts. I'll refer you, as I have in past interviews, Carrie, to the Barron's Gold Mining Index 50-year gold equities chart. What you will see in this chart is the incredible cyclical volatility in secular bull markets. The truth is that the gold equity indexes can fluctuate by 10% or 15% with the same ease that you and I inhale and exhale. What you are seeing now is an absolutely normal and natural fluctuation. Gold bull markets traditionally, in terms of duration, are 10-year-long affairs. We're 2 years into this.
Oh, wow.
In terms of dimension, they characteristically generate 500, 600, 700% trough to peak increases in price through the index, not the best stocks. So when people say, Rick, well, the price has gone from 1,100 to 1,900, have I missed the boat? I need to say possibly, but if you examine history, no. As to our current circumstance, I have probably been through 40 cyclical declines in secular bull markets. They might be unpleasant for some people, but they're completely predictable. In 1975, Carrie, I realized before you were cognizant, but not me, the gold price had run in the 1970, 1975 period from 35 US dollars to 200. Hell of a run, you know, hell of a run. And in 1975, we had a period, perhaps analogous to now, where the US government let the interest rate rise, which strengthened the dollar. And it took the gold price down from $200 to $100, a 50% cyclical decline in the secular bull market. They, of course, lost their nerve, as I think they will this time. And the people who got shaken out by that decline, or merely got bored, missed a move in gold over 5 short years from 100 US dollars an ounce to 850 US dollars an ounce. Is this a certainty? No. Is it a probability? Almost certainly. Is it a contingency worth securing against? Absolutely.
It's a little bit, I know this time it's different, Rick. And the reason I bring that up is earlier today we heard from Bron Sachecki from ABC Bullion, who was talking about money, gold, and cryptos. And my question to you is, there is a lot of government money printing, call it quantitative easing, calling it what you want. As you said earlier, if you or I did it, it would be counterfeit. But these governments, the printing machine keeps on going. However, we are going into a digital world. The price of Bitcoin has gone parabolic in the last few months. There is a lot of this, as I call it, funny money going into the wealth preservation, if you would like to call it, of the cryptos. Do you see that changing this secular gold market because there is competition in the form of a new digital, and I know you don't like the word, but it's technology?
No, I think that crypto will be responsible for popularizing gold to the Robin Hood generation. I believe they're both, because I believe that they're complementary assets rather than competitive assets. Remember that gold has value other than as a medium of exchange. It is in fact a store of value. It's useful in iconography, it's useful in jewelry. Crypto's utility really is the network and the low friction cost associated with it. Now, the blockchain can be utilized for trading any asset class, trading and authenticating any asset class, including, by the way, gold, where we have substantial investments. But I would argue that one of Bitcoin's utilities, its original utility was as a medium of exchange. It has two problems, which it may overcome in terms of being a unit of exchange. The first is the very volatility that traders enjoy. The extraordinary volatility in Bitcoin, until the network is large enough, if it ever became large enough, that economies were dominated in Bitcoin, means that transferal out of Bitcoin to something that you can more commonly spend makes volatility dangerous. If you buy a cup of coffee with a fractional piece of Bitcoin, you actually don't know what you paid, and Starbucks doesn't know what they received.
Yeah.
So the volatility that people enjoy obviates one aspect of its utility as a medium of exchange. The second is, for a certain class of people, gold has functioned as insurance. As I say, because it's simultaneously a store of value and a medium of exchange. There are arguments with regards to Bitcoin that it is a popular, spontaneously generated fiat currency. The wonderful Doug Casey joke that a dollar is an I owe you nothing, and a euro is a who owes you nothing, and Bitcoin is a we owe you nothing. Now, I understand that the utility there is in its semi-frictionless status, certainly the anonymity associated with owning it, and the network. It's difficult to see any of those taking on the same utility as being a store of value that gold affords. But remember too, that the market share of both Bitcoin and precious metals relative to other mediums of exchange and relative to other investment classes isn't small, it's infinitesimal. And the idea that ultimately, I'm not talking about 300,000 Robinhood speculators. I'm talking about in the context of the global economy. They don't matter to each other at all. They're absolutely irrelevant. There is so much share to take from traditional mediums of exchange and traditional asset classes that the relevance of gold to Bitcoin and vice versa is fiction.
You've said recently, we are talking about this, the money printing side of things as well. You've said recently that you're quite overweight cash in your portfolio at the moment. But earlier on in this interview, you actually said that if you're holding cash, you know, you are potentially going backwards. Why are you overweight cash at the moment when it is, by its fundamental, you know, there is no interest rate at this point in time? To me, that sounds like you're going backwards or are you looking at opportunity and the liquidity of cash?
Great question. 3 answers. The first, cash allows me to sleep nights and stay calm. And by the way, I regard my bullion as cash.
Okay.
Highly volatile cash, but good cash nonetheless. What you say is very true, Carrie. Cash balances, irrespective of the fiat denomination, reduce your purchasing power over time. But I consider that to be a necessary option cost because I see increasing volatility and I see the increasing risk, not the certainty, but the increasing risk of a crisis in trust, which would engender a liquidity crisis like March of this year or like 2008. What you find when you have cash in a period where trust disappears and liquidity disappears is that having the cash gives you both the courage and the tools to take advantage of the circumstance rather than being taken advantage of by the circumstance. I have now gone through 3 global liquidity crises well cashed up. And I can say certainly that every single one of those liquidity crises, while it was bad for most of mankind, was extraordinarily kind to me. I don't mean to suffer at others' adversity, but the fact that I thrived wasn't responsible for their demise. And if I had a choice between being a beneficiary or a victim of circumstance, I would at every opportunity be the beneficiary. So there's nothing inconsistent about the fact that I'm maintaining very high cash balances with the knowledge that my purchasing power on those cash balances is declining in the long term. My optionality in the near term, both financial optionality and also sort of intellectual freedom, is much higher.
Do you think that people need to have a look at what's going on? Excuse me, because earlier in the year, in about March, we had about a 30% pullback in the share market. And I'd like to talk about bullion versus equities and the difference that you see, because as I said earlier, there's a lot of people on this call, some of whom do understand the investment thesis for gold, but there are others who are not quite sure about how they can protect and grow their wealth, or should I say grow and then protect their wealth. In these times where we have had a bit of a pullback, and you've said that you like to be a little bit overweight in cash at the moment in case of a liquidity crisis, do you see that that potentially could come around again and that we have maybe a larger pullback than we did back in March at the start of the pandemic?
I'm not an economist or a market strategist, but looking at history, or maybe personalizing history, the 45 or 50 years that I've been an investor, we seem to conjure up some kind of crisis every decade.
Yeah.
I don't know if we're due for a crisis. I just know that it would appear to be a contingency worth insuring against. It's important to note in a liquidity crisis too, that the price of all assets, including gold, in the near term goes down.
Okay.
The sell decision is seldom made by the investor. It's made by the margin clerk. And he or she doesn't care about your preferences. They care about paying down the debit balance. And so everything that has a bid, including famously gold, sells off. What happens is that the policy response to a liquidity crisis is always printing, always quantitative easing. And so the beneficiary of the policy response is almost always gold. Remember too that gold stocks are stocks. And if stocks sell off, gold stocks will certainly sell off. But if the gold comes back, the gold producers' free cash flows will increase fairly rapidly, and you will see them outperform other types of stocks. Am I saying that we're going to have a liquidity crisis and a general market collapse in the near term? No. Are we saying that we're not? No, I don't know. I can tell you that there appears, in my mind, to be a disconnect between the robustness of financial markets and the softness in the general economy. Now, maybe equity markets are forecasting a tremendous economic recovery around the world. I don't know. When I look at the balance sheets of governments and countries and consumers around the world, I'm concerned about the recovery, but I hope I'm wrong. I should disclose bias too, Gary. I'm at the easiest a libertarian, probably more properly an anarcho-capitalist. And when I look at the excesses of government, and I look at the faith that people put in government, I become very naturally afraid. So I need to disclose to your audience that I have accurately called 15 of the last 3 downturns. So
I suddenly got that. It took me a moment, Rick, and I went, oh, okay.
I'm abnormally cautious, I think is the right phrase, despite being a wild speculator.
When you say you're a libertarian and an anarcho-capitalist, expand on that a little bit. Does that mean you're anti-government, or you look at the government and say it spends too much? I mean, expand a little bit on what you mean by that.
Well, those two are good giveaways, yes and yes. I believe, not that it will happen in my lifetime, that human interaction should be voluntary. I don't believe in the initiation of violence or the threat of violence or fraud, even to achieve my own ends. I believe that violence is only justified if you're defending yourself. So the idea that violence is okay if the majority of voters vote for it doesn't sit well with me. So Carrie, imagine what would happen in Australia if the payment of tax became voluntary. Would anybody pay? Without the threat of enforcement, would anybody pay tax? So if you look at it from my point of view, tax is extortion.
I
If
agree.
it isn't extortion, it's slavery, one or the other. And I think voters need to ask themselves how they feel about extortion and how they feel about slavery. Probably obviates the rest of my interview from people's mind, but since you asked me, I believe in a voluntarist, contractual, nonviolent society, something that will almost certainly never occur, but I believe in it anyway.
I was about to say, do you think that we're ever going to get to that point where, because I like you, I'm a libertarian, and excuse me, got a frog in my throat this evening, but never mind. Do you think that we will ever see that sort of a world that we will live in, or do you just see that the governments will continue to expand, that the governments will continue to print money to employ people to give the veil of trust and in a government that is out of control, printing the funny money?
I believe in my lifetime that there will be a political city-state established that's effectively libertarian. I don't know where. And I would point out that there are several tens of thousands, maybe hundreds of thousands of people who are conducting themselves effectively as stateless. They live in places where they weren't born. Their passports are issued by places where they don't live, and their wealth is held distinct from their passport, which is to say they're so-called PTs, perpetual travelers or prior taxpayers, depending on how you describe that. And I think this is a very healthy sign, but I do think we'll get to the point, because the belief in libertarian ideas is growing so rapidly and among so many accomplished people, but in particular, so many accomplished young people, that I believe a market-oriented solution, including a place, will ultimately be found. It may be that the people who are citizens of that place aren't domiciled there. You know, they might want to live somewhere more pleasant. But I believe in my lifetime that that'll come to be.
Wow, that's a big call. I want to go back to, after all this, and I find that area fascinating. We're going to have another chat about that another time. But given that this is a virtual gold conference, I'm curious to know if you're talking to a number of people on this conference today that are saying, well, Rick, the gold price is sitting around 1850 US. I haven't yet dipped into gold equities because I just don't know where I should go or what I should do. What advice would you give to people listening right now that have never dipped their dollars into this market, don't know where to start, sitting here in Australia? And by the way, we do have people on this call from Canada, from the US, from New Zealand, like we have had registrations from all over the world. So we don't need to be Australian agnostic, but what's your advice to people that are just scratching their heads saying, I don't really understand it? What's my safest option?
If you have listeners to this conference that don't own gold, I would say that the risks of not owning it are substantially greater than the risks of owning it. And if you don't own any at all, buy some and pray that the price goes down. Remember that gold is insurance. And if you think about it like that, how eager are you for your life insurance policy to pay off? You died. How eager are you for your auto insurance to get paid off? Your car got wrecked or stolen. On the other hand, how happy are you living without insurance? If you don't own gold, there are no certainties in the world, but I would suggest that the risks of not owning it are much higher than the risks of owning it. Now, interestingly, 3 months ago, when the gold equities were all the rage and they were going up in price, which is to say they were, I would suggest to you, as I did on our last interview, overpriced. People want them desperately.
Yeah.
When they fall 20% from those overpriced periods. In other words, they're 20% cheaper. Or in women's parlance, when they're on sale, people don't want them. Carrie, imagine yourself in Sydney and you're walking in a shopping district and you're walking down the street. And on the left side, you see a nice little sign that says, all goods on sale, 50% off. And on the right side, this is the bear market store. On the right side, there's the bull market store. All goods overpriced and going higher, no deals ever. As somebody who's shopping for, say, a coat, you're obviously going to go to the left. But strangely, people who are shopping for financial assets seem psychologically predisposed to overpay. A cyclical decline is a sale. It's a good thing, not a bad thing. It always makes me laugh when people who are attracted enough to an asset class that they style themselves as buyers get shaken out when their asset class becomes cheaper. I mean, think about this. If you're going to 10, is 4 better than 5?
You've often spoken about that as psychology as part of the investment thesis. But most people are fearful when others are greedy and greedy. You know, it's the old Warren Buffett saying. What are your views on the good, the bad, and the ugly of the psychology of investing? Because most people don't understand the psychology of investing.
The easiest way to wrap your mind around the psychology of investing is to read 2 books. The first is Economics in One Lesson by Hazlitt, which teaches you how the economy works rather than how you would have been taught in uni that it works. Very different, by the way. And the second, going right to what you asked, is The Intelligent Investor by Ben Graham.
Yeah, right.
In particular, 2 chapters. One, The Margin of Safety. And the second, the most important investment tome ever written, I think, is Mr. Market, which talks about the behavior of the mob in markets as manic depressive. And I think it's very accurate. We've talked before about this, Carrie, in earlier interviews. We believe ourselves to be rational fact seekers, taking information from all sources, processing it rationally, and making logical conclusions, which is ridiculous. What we do is we search the horizon for information that makes us feel comfortable, that supports our existing paradigms and prejudices. And with regards to information, we have a very high time preference, which is to say that circumstances that have occurred to us in the immediate past have a disproportionate impact on our view of the future. So if we have been spanked over the last 3 weeks, but have done well over the last year and a half, we tend to ignore history and focus on the recent spanking. And what that means is that the rational part of behavioral finance and also the lessons of history get lost to us because we react emotionally to the experiences that are freshest in our mind. And we need to guard against that. Everyone should know that they won't guard completely against it successfully. I've been striving now for 45 years. I've never mastered it, but as I get better, my performance improves.
Rick, it'd be really good to, because you do so much for other people. What I'd love to hear from you is, what was your most memorable positive investment experience? And what was your most memorable negative investment experience?
Let's do them backwards because I like to end on happiness. My negative investment experience was easy. In my 20s, in the 1970s, I was focused on resource investments and my peers were all focused on general market investments, at least those in finance. They experienced a bear market. You'll recall the general equities went a bear market from 68 to 82, 14 years long, an ugly one for them, while I was in a bull market. And I made the young man's mistake of confusing a bull market with brains. I thought I did well because I was smart, not because the oil price went from $3 a barrel to 30 or gold went from $35 an ounce to $850 an ounce. The other mistake I made was not understanding that markets work and that high prices or the cause of low prices because of conservation and overproduction. So in 1982, when that cycle ended, I found out just how smart I really was, which was to say not smart at all. And I went from being a very rich, hubris-ridden young man to having a net worth that was below zero.
Oh, wow.
So that was easily the most important negative experience. Now, the truth was that pain caused me to learn lessons that have made me and clients a fortune since. So it was very, very beneficial.
What were those lessons? Because that's interesting, because
Well,
because as a young man, you know, and as you said, quite wealthy at that point, to have it all taken away, you don't have anything. How do you pick yourself up from that? And I bet that at that point in time, there was a little bit of ego in there as well.
there was an awful lot of ego going in, none coming out, which was useful. The lessons were that markets work. The fact that the price of commodities had gone up meant that people were using less of them and producers were producing more of them. And in a market where supply increases and demand decreases, guess what happens to price? There's a truism in cyclical businesses, which is that you are either a contrarian or you're going to be a victim. I wasn't a contrarian, and I was in spades a victim. But experiencing that taught me the lesson of cyclicality, and being able to use that story on younger audiences manages to teach the lesson, at least to the smarter ones, in a way that no book could. Personalizing it helps. The best experience will be useful to your Australian audience. I figured out in the later part of the 1990s two things. One, that uranium was horribly underowned. People weren't merely bored of it, they hated it. And that the Australian resource market, and in particular the Australian junior market, was the most bombed out equity market on the planet. I remember going to Diggers and Dealers in 1998, and I was the only non-Australian in the crowd. The people in the booths looked at me and saw basically fresh meat, a new victim. I mean,
I could just imagine.
I mean, you know, I knew how the skimpies felt, except there was only one of me, you know. So those two things, you know, sort of stimulated my contrarian juices. And I found a wonderful guy, a friend of both yours and I, John Borshoff.
Yeah, lovely man.
Who was the most completely committed to the thesis of any human being I ever met. If you said to John, it's a nice day, he said, yeah, it's a nice day to be in the uranium business, you know, despite the fact that everybody hated him. And so I loaded up on his company, which I believe had $1.6 million Australian market cap. You know, in American parlance, you know, 4 candy bars and a Coke, kind of. And I think he let me in at 10 cents with a full warrant. Australians never gave warrants in those days, but there was no other victim, so he had to give me a warrant. Kerry, I was rewarded for my genius by seeing the price go from 10 cents to a penny.
Oh.
That is a 90% decline over a year and a half. Now, if you're down 90%, that buy, sell, hold equation doesn't work. There's no such thing as hold. You either buy or sell. And I was forced to revisit my premise. And as I revisited my premise, I figured out that I was right and the world was wrong. And so rather than blowing out the dime stock, we bought a bunch of stock at $0.015. 5 years later, Kerry, 5 years later, the stock was at 10 Australian dollars per share.
I do remember that going up to, yep.
There are a lot of lessons there. One is that rising markets are more fun than falling markets. But the other is, if you have bought for the right reasons, you have to have the courage of your convictions. And you have to take extraordinary risk in a sector where you have no company at all to make extraordinary speculative returns. This is not an investment strategy, by the way. Yep. All the money I now invest sagely, I made by speculating like a maniac in my youth. That being one of the prime examples.
It's interesting. Do you look at the Australian market at all? And I'm talking in terms of precious metals, of gold, or are we just a little bit too small and not on the radar anymore? I'm interested in, and also the silver market, gold and silver.
We are way overweight the Australian gold market.
Okay.
The Australian gold market went from being pathologically cheap 6 or 7 years ago to being overpriced 2 years ago to being underpriced again today. I would argue, Carrie, that there is a more responsible culture in gold mining in Australia than in the rest of the world. There is a direct connection in Australia between rocks to money. In the rest of the world, it's been perverted, rocks to stocks and stocks to money. That isn't to say that there aren't some, as you would call them, rotters or punters in Australia. But the industry is still geared around raising money in capital markets, employing it in the ground and turning that into profits, which is different than what is happening in other parts of the world. You enjoy a virtuous circle in Australia too, which I suspect may be ending. That circle being a declining Australian dollar relative to the US dollar. Gold is sold in US dollar terms, so you sell your product in appreciating currency while your costs are denominated in a decreasing currency, which does a wonderful things for margins, separate and apart from efficiency. The third thing, and we discussed this in our last interview, Carrie, is that Australia has resources that are non-natural, which is to say the human resources and the infrastructure around mining and mining finance and mining regulation in Australia. It isn't just that mining in Australia is important, but Australians participate and lead in mineral exploration production around the world. The export of Australian technology and services related to mining is one of the great unsung economic advantages that Australians have, and something that's interestingly seldom celebrated in Australia, which is odd. But from our point of view at Sprott, we are substantially overweight the Australian companies relative to their market share of gold companies worldwide.
Well, look, we don't have a lot of time left. We've got a little bit of time left. Before I get on to how people could possibly, for those people that say, you know what, I like what Rick Rawls talking about, but I'm not quite sure what to do, and I don't have the time to go and do the research and understand the financials behind some of these companies. We'll talk about how they can get involved with potentially just saying, can you look after my funds for me? Because I'm not sure what I'm doing. All care, no responsibility from my point of view, ladies and gentlemen, but all care from Sprott's point of view. But before we get into that, what advice would you finally give to those people listening today in terms of percentage, or do you not give that sort of advice? Cash, equities, physical gold, ETFs, royalties. I know I'm giving you a lot here, but there are it's a volatile market. There are lots of options. There's lots of confusion and there's lots of misunderstanding. Love to hear your views.
Carrie, I'm not ducking the question. I honestly don't believe there's a one-size-fits-all answer. It depends on every investor's personal circumstance, not merely their financial capabilities, but their needs, their risk tolerance, their time preference. I've been asked that question for 40 years, and I tried for about the first 5 years to answer it before recognizing that answering it really constituted a mistake.
Right.
I think it's a wonderful question, but I think that investors need to ask it of themselves and then discuss it in conjunction with first probably their spouse, but then their financial advisor. I don't think that it's something that a supposed guru like myself ought to attempt to answer for all people. I would say this, maintain more liquidity than you think you ought to. Liquidity allows you to sleep nights and stay calm. The essence of well-being. This makes me sound like a lotus-eating Californian, Carrie, or perhaps a Kiwi. But
oh, steady.
Liquidity enhances your sense of well-being, and I would say that the essence of wealth is enhancing your sense of well-being. It allows you to sleep nights and stay calm. And I think that's a very important attribute. It also, of course, as I said earlier, gives you the ability to take advantage of scary situations rather than being taken advantage of by scary situations. I would tell people too to be a little less speculative if they aren't willing to work very hard. If you think about a gold bull market as being one that in terms of duration is usually 10 years long, we're only 2.5 years into this one. And if you're talking about one that in terms of dimension goes up by 500 or 600%, we're only 20% into this one. So if you think about the fact that from a historical context, we have 7 or 8 years to go and 300 or 400% to gain, the idea that you take a bunch of risk and spend a bunch of time outperforming the index is stupid. Put some percentage of your portfolio in the very, very, very highest quality gold stocks that you can. Be content to even underperform the index a little bit, but de-risk it with superb companies so that you don't snatch defeat, that is to say, company failure, from victory, which is a secular bull market.
All right, so Rick, we are coming to the end of our chat. And as always, I just, you are a busy guy and I really appreciate your time so much, because it is information like yours and the time that you give for the people here, because my passion is about helping people to understand about investing in the sector and help them not make the mistakes that people tend to. And by the way, can you just hold up that drink again? Ladies and gentlemen, look at this.
Pandering to my Australian audience.
Diet ginger beer by Mr. Rick Rule. Talk about product placement, but it's Bundaberg for all you Queenslanders on the call. How good is that? When did you decide that you liked Bundaberg Diet ginger beer?
My wife and I lived in New Zealand for an extended period of time.
Oh, I'm sorry.
We were introduced to Bundaberg in New Zealand, but I also enjoyed it at your conference, in fact, in Sydney at that odd amusement park.
Okay, that's good. Now, let's talk about how people can get in touch with you. You did talk about the Barron's Gold Mining Index before, which is pretty interesting. There's been a lot of information you shared with us today. If people want to get a hold of you, Rick, or they just want to say, you know what, I still don't understand it, but he sounds like he's an intelligent guy. I'm going to get him to manage it for me. Can they do that?
Two things, Carrie. I hope you interview me in a month or two, because we're planning an entrance into Australia, which I haven't told anybody about before.
Oh.
But as soon as I'm able, I'd like to tell you and your audience about it. But in terms of getting a hold of me, I'll give your listeners and viewers an incentive. If they go to a website, Sprott, S-P-R-O-T-T, USA.com/rankings, sprottusa.com/rankings, and they enter their natural resource stocks, names and symbols. Please, no cannabis stocks, no retail stocks, just things I understand. I will personally rank those stocks 1 to 10, 1 being best, 10 being worst. And I'll comment on those issues where I think my comments might have some value. In addition, I will include the Barron's Gold Mining Stock Index and a wonderful 100-year commodity chart that Australians should love. It talks about just how cheap commodities are relative to other asset classes over the last 100 years. So once again, the website is sprottusa.com/rankings. The offer is a no obligations portfolio review, 1 to 10, 1 being best, 10 being worst, the Barron's Gold Mining Index chart, and the 100-year commodity chart. And the teaser is that at some point in time in the future, Carrie, I would love to visit with you about specifically what we're trying to accomplish in Australia, but we're not quite there yet. That
will be fascinating. I will very much look forward to that. I have a question for you on the ranking side of things. There's a lot in listed on the ASX, a lot of gold companies out here. You across all of them, or in the rankings, would you just turn around and go, no idea?
The rankings, by the way, draw on the whole resources of the Sprott universe, not just me. I make the final decisions.
Right.
And at present, I think we have 1,051 stocks on the ranking lists. So many people with sub 40, sub $50 million Australian stocks will get a remark back that says no opinion.
Right.
What we've done is, if we have a stock that, as an example, we have 30 or 40 requests on from Australia, we assign our team to come to understand it. So the list rises or falls, depending on demand for expertise. And we've actually learned a bit about the Australian penny dreadful market as a consequence of responses from your listeners and viewers, for which we thank you.
Well, Rick, it's been an absolute pleasure to chat with you today. I'm looking forward to hearing what it is that you're going to be up to in the Australian market in the future. But for now, we're going to give you a virtual Zoom. Thank you so much. And I look forward to hearing from you again. Thank you for closing out the second virtual gold conference hosted here in Australia and around the world. Thank you so much, Rick.
As always, Carrie, thank you. I look forward to seeing you physically as opposed to virtually someday.
Maybe back at the Vancouver Sprott conference in the near future.
As they say, your place or mine.
Cheers, Rick.